Once again, welcome to Goldman FX. Goldman FX, you learn to trade smart money concepts the right way. I hope my audio is clear. All right. Now, as I was saying at Goldman FX, I teach you smart money concepts. You are going to learn here that smart money concepts actually is a way to think. From the word smart money concepts, it is a concept. Now, if you look at this word, a concept is an idea, all right? Concept literally means idea. So, in other words, we can say smart money idea. So, it's not exactly a strategy, but it's a way to think. Now, in smart money, we believe that institutions control price, all right? So, the idea here, the idea is that institutions control price. That idea, institutions control price. Now, those institutions are the banks, hedge funds, all right? We have central banks, commercial banks, hedge funds, etc. Okay, so these are who we refer to as the institutions in smart money. From the start, we say smart money is a concept. A concept is an idea. So smart money concept can easily be called what? Smart money idea. Is an idea. Now, the idea in smart money concept, all right, is that we believe that institutions control price. And so whenever we are on the charts, the idea is that institutions, so as a consequence of this idea, smart money traders, and as a consequence, aim to mimic the movement of big players. Now, I'm going to explain why this makes sense. Because maybe when you get into trading, they tell us that retail traders make up around 5 to 7% of the globally traded volume. The other 95 to 93% is contributed by the big banks. Now, that should tell you that if a demography of participants control 95%, up to 93 to 95% of the entire $7 trillion volume, that tells you that they are the ones that decide where price goes. So that if the institutions are buying something, then the price of that thing is going to be bullish. If the institutions are selling something, the sheer volume that they are offloading will drop the prices of that commodity or whatever it is. Now, in order to be on the right side of the market, smart money developed a system to always trade like the banks, to mimic what the big players are doing. Now, so in smart money concepts, we trade the footprints trade the footprints of the big players. So as a smart money trader, you are not looking to start the move, all right? You are looking to see the move start so that you can capitalize on it. Now, because we know that the institutions contribute 93 to 95% of the entirely global traded $7 trillion market volume, it makes sense to want to be on the side of the institution, all right? Because if you are buying with your little funds and the institution is selling, you lose money. So in order to reduce losses, smart money traders aim to mimic the institutional players, right? We want to trade in the direction that they are trading. Now, how do we identify institutional trading? Because it's one thing to want to do what they are doing. It's another thing to be able to identify what they are doing. Now, the way SMC identifies institutional trading of movements, okay, on the charts is by manipulation and expansion. I'm going to explain why there always has to be a manipulation and expansion. I just want you to pay attention. Now, since we understand that the institutions control price, and whenever we want to trade, we are looking at institutional movement, why does SMC identify institutional movement as manipulation and expansion? I'm going to explain. Now, the truth is that over the years, traders have learned to apply different strategies. There's demand and supply, there's support and resistance, there are the like. And new techniques are making retail traders, I'm not going to say making retail traders smarter, but they are providing smarter ways to go about trading. And if the institutions want to buy or sell, the volume that they are bringing in to buy and sell cannot be exchanged directly in the market. For example, if institutions are looking to buy $100 billion worth of gold, and on the market, there are not enough sellers willing to sell $100 billion worth of gold or currency or whatever the case may be, that transaction cannot occur because the market works with volume. Now, what is important is the volume that is coming in from buy side to sell side. There are two participants in the market. There are buyers and there are sellers. Okay? Now, price deals with volume, not number of participants. So in order for transaction to happen, the volume of the buyers has to be equivalent to the volume of the sellers. The market is always looking to attain a state of equilibrium. What do I mean by a state of equilibrium? Where there are no external forces acting on it. So when the market is trending lower, or when the market is trending higher, it is doing so in a bid to achieve equilibrium. Now, when the market is at equilibrium, it is not moving, it is resting. We call that a ranging market. When the market is ranging, it just means that there is a balance between buy side and sell side. But when the market is trending either to the buy side or to the sell side, it means that there is an imbalance. Something is deficit and the market is moving upwards or downwards to try and replace that deficit. So if the buyers want to buy, probably they want to buy 100 billion US dollar. They want to sell their euros to buy $100 billion. And then there are not enough US dollar owners that want to sell it to buy euros. Something has to happen. All right. Now, smart money When I say smart money, we're going to refer to smart money as the banks and the big players. They would create the right conditions for their orders to be executed or to be fulfilled. How would they do that? They do that by inducing market participants. Now, an inducement is something that makes you to act in a certain way or do something while hiding or while keeping the original intention hidden from you. So that if somebody is making you do something without revealing the true intent as to why they want you to do that thing, that's an inducement. All right. Now, we've not gotten to that level, but by the time we get there, you would understand. We cannot talk about institutional price action without talking about an inducement. Now, on the chart, so when they want to execute these orders, they have to create the right environment for it. For example, if you and I go out, we go to the market, probably we want to buy shoes, these trendy Air Force One sneakers. And then we go to a market where everybody sells shoes. And then there are 5 shops that all sell Air Force One sneakers. And we have an idea that the regular range of an Air Force One sneaker should be around 30 to 50,000 naira. Okay? 30 to 50,000 naira. But these sellers now, they want to sell it at a premium, maybe 100,000 naira. But you and I, it has been a while since we bought. So we are gone to the market. The first shop, they say 100,000. Second shop, they say 100,000. Third shop, they say 100,000. Down to the 5th shop. Now we are there. We are reluctant to buy because 100,000 is too expensive. Now, something is going to happen. Somebody is going to come in to that shop. Now, you and I, we don't know that person, but the owner of the shop knows the person. And the person is just going to come. He say, bros, I won't buy a Force One sneaker. Say, how much? The seller will say it's 100,000. Person will say, your own cheap. I don't dey waka for market since they tell me 120,000, 150,000. Oh yeah, give me now. And then the person pays the 100,000 naira. Now, what has happened there is not real because they know each other. We've been deceived. But if we were reluctant to buy at 50,000 naira, and somebody comes in and says, oh, this thing is expensive. This 100,000 naira is a discount. You and I will be convinced that getting that sneakers at the 50,000 naira rate is a discount. So at the 100,000 naira rate is a discount. So we have been induced. So an inducement itself is something that causes or makes people to take decisions that they will not naturally take. All right. So it's a deceptive move. Now, so when there is nobody to sell what the institutions want to buy, or when there is nobody to buy what the institutions want to sell, the institutions will create a fake environment to induce market participants. Now, let's use gold. All right. Or let's use gold. Now, 1 ounce of gold is about $5,000. Now, the institutions, they want to sell gold. The institutions want to sell gold, all right? Now, so far, so good. There is nobody that is willing to buy at $5,000. Now, the institutions will now buy gold at $5,000 and push it to maybe $5,500. So, and you know that on the charts, when price moves from $5,000 to $500, we'll most likely see something like this, a break of structure. Because if this was the previous price at $5,000, $5,500 is higher than that point. So we have a high, higher low, higher high, 5,500. But remember that the original intention of the institutions was to sell gold. So what they've done is that they've created a fake demand. This buy move is an inducement. This entire buy move is an inducement. What is that buy move going to do? That buy move is going to cause new market participants and other smaller institutions, both retailers, smaller institutions, they are going to see this new break of structure as a new demand, meaning that price is no longer premium because new set of buyers have come into the market. So they will want to buy at this level. Now, the institutions will now offload their real sell positions because new buyers have come in at this level. There is now a demand for that price they are willing to sell. They will now offload their volume, and then the people that got in here will be taken out of the market. Their positions will be manipulated, providing the sellers with the necessary liquidity that they need. Now let's come back to that. So when we look for institutional price action in the chart, we are looking for what? That manipulation. That manipulation. Now that manipulation is caused by what? That inducement. So when price creates a fake move, price is creating a fake move because it wants to manipulate market participants. That is why we look for what? Manipulation. Then after the manipulation, price will now expand in the true direction that the institutions or smart money wanted to go. So we look for manipulation first and then an expansion. Now, manipulation and expansion is popularly called what? Sweep and break. This thing we call sweep and break. Basically, that's what is happening here. You can see that this fake move took out the previous high. So that was a fake BOS. And what happened to the people who got in here? They got taken out of the market and the market actually broke to the downside. So this fake BOS will now become a stop hunt, and then the true BOS will now be to the downside. So that sweep and break is what we identify as institutional movement in the chart. So as a smart money trader, you are looking for manipulation and expansion, all right? So let me give you a rough schematic. If we've had price ranging, okay, no clear direction, above the range, we have buy side liquidity. Below the range, we have what? Sell side liquidity. Now, when you see price buy like this, breakout traders are going to think, oh, there is a breakout. So what do they want to do? They want to get in at the retest and continue to buy. But this is a false breakout. And then price will do what? Price will now offload the sell positions. Now, those early buyers will be taken out. And what will happen? Price will continue to trade to the downside. Give us what? A BOS. So what has happened there? Early buyers have been what? Induced into the market. What happens there is that early buyers have been induced into the market. Now, this is exactly what we are looking for in smart money. If you now take this out on your market structure, it will now begin to translate into things like this. So when price manipulates, breaks to the opposite direction, or manipulates and expands to the opposite direction, this becomes what? Our recent leg of structure. That is what we call our recent structure. A leg of structure that has featured what? Manipulation and expansion. Now we know that we can be comfortably looking for sales from this supply because price has already sponsored a manipulation here, and there's no logical reason for price to be seeking for liquidity above this high. So if price is seeking for liquidity above this high, that means price is now interested in what? A change of trend. Price is interested in being bullish. But because there has already been institutional movement, right here that sponsored a manipulation and an expansion, then we know that we can now be looking at this level to engage. All right. So this is how we identify manipulation and expansion on the chart. What is popularly called sweep and break. Now, SMC provides the context to which people are chasing sweep and break. Now, if we say SMC is a concept, then what is the actual concept in SMC? The fact that something is being manipulated and something is being expanded towards, what is common between the manipulation and the expansion is liquidity. So price manipulates liquidity and also expands towards liquidity. So the common thing that unites smart money traders, regardless of the strategy that they use, is liquidity. So for you to be a smart money trader, that just means that you factor in liquidity when you are trading. I hope this explanation is clear. Now, what is the strategy in SMC? What is the strategy in SMC? If we say SMC is a thought process, so SMC is the idea, then what is the strategy? The strategy, the approach in SMC, we look at the market through the lens of structure, liquidity, and POI. Now, this is our strategy. This is our approach. But market structure, liquidity, and POI is more than just a strategy. It is the actual chronological order in which we should approach the market. So the first thing you are looking for is market structure. The second thing you are looking for is liquidity. The last thing on your mind is what? POI. Now, if you come into the market and the first thing you are looking for is POI, you are wrong. You will most likely get your analysis wrong. That is why you hear people say, oh, there was a 4-hour order block here, but it failed. How can you come into the market and be looking at a 4-hour order block? It is wrong. You are doing it the wrong way. You have to start from market structure. Market structure will tell you which liquidity you are looking at. Then liquidity will tell you which POI you should consider. So this is the right way. Not only is SLP the name of the strategy, SLP is the chronological approach that must be followed. It is the laid down procedure. Now, when we talk about structure, we're going to talk about different things, all right? When we talk about structure, we also have to talk about the trend. Before we talk about structure, we have to talk about what? Internal and external structures. So when we talk about structure, we'll talk about internal and external structures. Okay, so when we talk about structure, we talk about internal and external structures. Then when we are looking at internal and external structures, we also want to look at the trend inside of them. Okay, so there are two types of trends inside of our structure. We have continuation and reversal. Continuation and reversal trend inside of your structure. Okay, now let me give you a schematic. When we have price moving in an upward direction, we say market structure is bullish, right? But price does not always buy. Sometimes in a market structure, price will sell. Now, there are short-term sales within a bullish structure. When you are mapping out your structure, this is your low, this is your high, this is your higher low, this is your higher high, this is your higher low, this is your higher high, this is your higher low, this is your higher high. But within this structure, there is a trend so that you can have something like this on the lower time frame. Have something like this. Have something like this. Now, this thing that is going on inside of the structure is what we call the trend. Okay? Now, remember that we talk about internal and external structures, right? So this is external. This is external. This is what? External. This is what? External. This is what? External. And this is what? External. But everything that is going on inside is your internal. Everything that is going on inside is your internal structure. Are we together? So that when you are labeling it, when you are looking for your external structures, you are just looking for what? Your swing points. This is your external low, external high, external low, external high, external low, external high. Those are your external structures. Your internal structures is now all of this internal trend, this internal movement here. They are your internal structure. Okay? But holistically, this alone is your external structure. While what is going on inside, they are your internal structures. So we now begin to look for continuation and reversal. Now, this trend that leads to a new break of structure is your continuation. The trend that leads to a new break of structure is your continuation trend. So right here, we have BOS. Right here, we have BOS. Right here, we have what? BOS. So that trend that leads to a new break of structure, that is your continuation. Meanwhile, the short-term sell is your reversal. Okay? So you have to understand what is the structure saying, what is the trend saying. We can have a bullish structure with a bearish trend. So when you have a bullish structure and you're having a bearish trend, what does that tell you? Price is actually printing a reversal. Now, this will now translate into liquidity. Okay? Let me show you how this will translate into liquidity. You now understand that what is the objective of a continuation? What is the objective of a reversal? So when you are trading a continuation, remember that the continuation is the move that leads to a new break of structure, right? So your continuation, the objective of continuation, let me put this right here. Objective of continuation, I'm going to use OBJ to short form as objective is what? External liquidity. External liquidity. Meanwhile, the objective of a reversal is to take what? Internal liquidity. The objective here is what? Internal liquidity. So now understanding the trend within your structure will now tell you the type of liquidity you should be targeting. You see how they are intertwined with each other? We have structure, we have liquidity, then we have POI. Now, after you have been able to successfully map out your structure, you would now understand that inside of this, my structure, we are currently in a reversal leg or in a continuation leg. And if we're in the reversal leg, what is my objective? My objective is to target internal range liquidity, all right? Which could be pullback or fair value gaps, which could be pullback or fair value gap. Those are your internal liquidity. For your external liquidity now, they are the external high or the external low. In the case of a bullish market, we are talking about external high that will lead to a new break of structure. Now, after you've identified your liquidity, then comes your POI. So after you've identified liquidity, the next thing to do is to identify the closest flip zone. So we talk about POI, flip zones. Basically, POI are flip zones. So flip zones are areas on the charts where there is a handshake. Now, flip zones are areas where there is a handshake between buyers and sellers. Now, if price has been buying, all right, you see that the reversal leg is not taking out the external liquidity, breaking structure, which are breaking structure, coming back, breaking structure. So the behavior of price has been bullish. Now, the moment price takes out a previously protected point, something is created there. There is a handshake. That means this level becomes a flip zone. What has happened is that supply has taken out demand. So, or price has broken through that level of support, which will most likely be retested for what? Resistance and either continuation to the downside or price will continue to the upside. So every POI on the chart is a form of flip zone, be it order block, even if it's an order block. What do we say is an order block? An order block, in layman's description, is the last opposing candle before an impulsive candle that led to a break of structure. So if price has been bearish, printing bearish candles, okay, and then we have what? An impulsive candle to the upside. So what has happened? The high of this bearish candle is a point of resistance. It has been what? Broken. So this is going to be like an engulfing candlestick. And we expect that when price comes back, it should respect that and continue. So that tells you that what? Resistance was broken, retested as support. So in the case of another block, in the case of a breaker block, or any other type of POI that you are using to execute, there is a type of demand to supply flip zone inside of that POI. In fact, that is what makes POI work. For a POI to work, it must be a type of flip zone. We say that flip zones are areas on the chart where there is a handshake between buyers and sellers. Buyers will say, oh, we have moved price to this extent. Sellers at this point, you can take over. So that is how we look at smart money concept. We look at it through the lens of market structure, liquidity, and POI. Now, any system of trading that interprets price through the lens of structure, liquidity, and POI is smart money concept. It doesn't matter whether it's called SLK. It doesn't matter whether it's called market maker business model, MMPM. It doesn't matter whether it's called whatever it is called. All right. It's all under the umbrella of SLP. SLP is the strategy. SMC is the idea. SMC is the idea that says that we want to mimic or we want to copy the movement of the institutions. How do we do it? We do it by considering market structure, liquidity, and POI. Now, in this course, you are going to be learning to trade smart money concepts. All right? But you'll be applying everything you learn in smart money concepts to demand and supply. So if somebody asks you, what does Goldman trade? Goldman trades demand and supply using smart money concepts. So I'm actually a demand and supply trader. I trade demand and supply. Yeah, using smart money concepts. This is how I trade. Because by any time you begin to hear BOS, this is what? Demand and supply. You begin to see BOS, break of structure, is demand and supply, okay? Any strategy that talks about break of structure is demand and supply. Now, I trade demand and supply, but what? I use smart money concepts to approach demand and supply. Now, what is that one thing that regardless of strategy, all smart money traders do in common? What we do in common is that we factor in liquidity to our strategy. So even the guys that are trading CRT, which is candle range theory, you might not exactly see them marking out market structure to say this is a BOS or this is a change of character. They focus on the formation of candlesticks. But for the singular fact that they factor in liquidity into their trading, they are smart money traders. So in demand and supply, what are the topics that cover our core curriculum? Now, the topics that cover our core curriculum, we start from introduction to market structure. Of course, it is very important that we understand market structure. So the core concept that I teach, is centered around this topic. Number one, we have what? Structure. Market structure, to be precise. We have market structure. All right, we're going to talk about market structure. Next, we are going to talk about liquidity extensively. Then, of course, we are going to talk about the range concept, which has to do with the Fibonacci tool, of course, how we use it to measure premium and discounts and other things that we use it for is contained in the course. Then at number 4, we have point of interest, of course, POI. At number 5, we'll talk about trade management. Oh, no. Yeah, actually. The other one can be a subtopic. Then we'll talk about trader psychology at the end. Okay? Trader psychology. So these are the 6 pillars of what you are going to be learning for the next couple of weeks. Now, when we are talking about market structure, we'll now talk about primary and secondary structure. We'll talk about internal and external structure. We'll talk about recent and swing structures. And of course, we'll discuss the logic of trading the logic applied to trading recent and swing structures. Then we'll talk about liquidity, all right? We're going to talk about major and minor liquidity. We're going to talk about institutional order flow as part of liquidity. That's what I was thinking of putting as part of the list. Personally, I am biased towards taking institutional order flow as an independent part of the curriculum. But in institutional order flow is how market structure and liquidity relate with each other. So I can initially in past lectures or in past mentorship modules, I listed it as an independent curriculum, but as an independent topic in the curriculum. But recently, I've been considering it to be, part of liquidity and market structure. All right. So it could either be a topic on the core curriculum or it could be part of liquidity. It doesn't matter where it occurs, but we're going to discuss it. Then we would also be talking about how to, identify the right liquidity, to know where your liquidity is, right? So I'm going to leave that. Then we'll talk about the range concept. We're going to discuss defined ranges. We're going to talk about defined ranges. Then we're also going to talk about the application. We're going to also talk about range cycles. We're going to talk about range cycles. We'll also talk about the application of ranges. Okay? The application, or let's just call it the range methodology. Yeah, the range methodology. Then when it comes to POI, we're going to talk about, first of all, we're going to talk about different types of trading models, aggressive and conservative entries, okay? That's in trading styles, aggressive and conservative. Then we're going to talk about different types of POI, all right? We're going to talk about the types of POI. You must have already seen some of that in the course, types of POI. We're going to talk about where they occur, how to use them, where to find them within the range, how to select the right POI, all right? How to select the right POI. Then we're also going to talk about, when we come to trade management, we're going to talk about things like using stop loss, how to use stop loss, what a stop loss is. So let me just call it stop loss. Break even. These are independent terms. And there are actually logical processes to using them. All right. We're going to talk about break even. We're going to talk about trade management, like trailing stop losses. I'm just going to use SL there to minimize what I have to type. there is actually rules to trailing your stop losses, to setting your stop loss, to setting your break even. Okay. Now we're going to talk about the elements of a quality trade setup. Of course, now there is putting it all together. We should have something for putting it all together. All right. Then number 7, we're going to talk about trader psychology, the right mindset. So putting it all together, we're going to cover topics like top-down analysis. I know top-down analysis. All right. So basically, this is what we are going to be covering over the next couple of weeks. Practically, everyday trade setups, wherever these things occur, you are going to be seeing how to use them, how to frame them within the right context. You are going to understand that smart money concept is beyond ABC pattern. Smart money concept is actually beyond ABC pattern, where you have your A, you have your B, and you have your C. So price sweeps this break structure. Smart money concept is beyond and bigger than ABC pattern. So regardless of the fact that we know that institutional movement is characterized by manipulation and expansion, but there is a context. We are going to be talking about the right context and how to apply smart money concepts in trading demand and supply. Now, in your course outline, there are some videos. All the videos there, they have been labeled, and you have to watch them according to the way they are labeled, right? Let me open it. So, right here, this is your course outline. You're going to start with market structure. We're going to talk about the elements of market structure, primary, secondary, internal, and external. That is what the first 3 cover. So your element of market structure covers your primary, secondary, as I discussed, up to number 3. So we have the first 3. Then this is also for you to put it all together. In understanding structure, it puts everything you learn in 1, 2, and 3. You combine them together in understanding structure. Then we talk about BOS, change of character. When you have a BOS, when you have a change of character, how to trade them exactly. Then we talk about order flow, BOS and stop on, they complement each other. Then here you learn at number 6, you learn to define your internal and external structures. At number 8, you learn to identify your swing and recent structures. Number 9, you learn the logic in trading your recent structures. Okay. Then at number 11 and 12, you're going to learn your market trends, the reversal and the continuation. Remember that at the beginning of this class, we talked about reversals and continuations, right? So that's that about that. So right now, you are going to start with this folder. There is still a lot for liquidity, the range methodology, POI, top-down analysis, and the rest. But we are going to start with market structure, where you are going to have an intensive training. After you watch on the weekly sessions, we are going to be looking at market structure for different pairs. You are going to be showing me how to mark them out as according to what you have learned. Okay, so this session is an introductory session to show you how to go about the course outline. So after market structure, you go into liquidity as it is written right here, as I have arranged it right here. Then you study the range concept, you study POI, then you study trade management, we talk about top-down analysis, and finally, trader psychology. All right. So